The first half of the year was eventful to say the least, and the third quarter has had its ups and downs. Today, I wanted to highlight 8 things that we're watching here at EverThrive Financial Group as we head into the fourth quarter and what this may mean for investors. As many of you know, I'm Valerie Leonard, founder and CEO, and with September nearly behind us, it's a natural time to review and reassess your investments as we get closer to the new year. As you football fans know, coaches may make changes to the playbook even when a game's in progress to protect a lead or to try to win from behind. As market and economic dynamics shift, let's talk about what this means for a fourth quarter strategy for you. So there's 8 things, as I mentioned, that we're watching closely this month, and I'm going to just dive straight in, basically. Number one is a big one and really important for you to understand, especially in context of how the markets are currently performing in 2023. So Apple and Microsoft together now represent over 14.5% of the S&P 500 index. And an August report in this chart from the Capital Group highlights that nearly 74% of the returns that we've seen in the S&P 500 this year from January through June could be attributed to only 7 stocks. Okay, so what does this mean really in all reality, Valerie? Historically, highly concentrated stocks as a percentage of any index signal a potential red flag. So these 7 companies, Apple, Microsoft, Google, Tesla, Amazon, and Nvidia, and also Meta, they're basically generating most of the returns, while the other 493 companies that make up the S&P 500 have only accounted for 26% of the index return, even though those 493 companies represent 72% of the weight. So if we see any blip on the radar for these 7 companies, especially Apple and Microsoft, who are collectively responsible for 32% of the index's returns, this could rattle portfolios that have exposure to the S&P 500. Also, if you yourself are comparing your portfolio's performance to the S&P 500, you may want to reevaluate whether it's giving you a true picture of how your own account is performing in relation to the overall market. Unless you have high concentrations to these 7 companies, you may be comparing apples to oranges. Second, it's not new news that we've seen a profit recession when it comes to corporate earnings. We are now getting close to 2 years of decelerating profits for corporate America, and this is likely to continue. Earnings concerns can create additional volatility because expectations surrounding earnings can help dictate which direction the market may move in the future. It's important to note that analyst earnings estimates for October are rising, so we'll have to watch this closely because if analysts are too optimistic, investors believe that their estimates are accurate and earnings actually don't meet expectations, it could lead to further volatility if companies miss their earnings expectations. So we'll be keeping an eye on this. So, what's performed the best this year so far? Healthcare, consumer staples, utilities, real estate. These are all areas that have struggled this year with those indexes being negative. The best performing sectors have been communication services, technology, consumer discretionary sectors, with all the remaining sectors just putting up lackluster returns. Another really important point here can be illustrated on this asset class quilt from the end of the second quarter. So I've pulled out the top and bottom boxes for second quarter, and you can see them on the right side of the screen. Last year, commodities were the top performer, and then through June, they were the worst performing asset class. The reverse is true for growth stocks. Last year, they were the worst performing, and this year, they're the best performing asset class. So this big shift is a reminder of why diversification in portfolios is so important. Now, we are watching commodities closely because we have really seen oil prices, for instance, and really the majority of commodities, those prices have accelerated. So we'll keep a close eye on that. We took a look at the U.S. quilt in the last slide, and at the end of the second quarter, the S&P 500 was actually performing better than any international market except Japan. But international markets are poised to do well going forward. So many investors are underweight in international market exposure right now. And this is an area that may need to be reevaluated in your own portfolio. Next, slowing corporate earnings mean banks are likely to make fewer loans. We've seen lending activity continue to decline almost every week this year. So fewer loans mean less economic stimulus and potentially higher cash flow risks to businesses. So this is an area we'll be watching as well. Sixth, despite a short pause in interest rate increases, the Fed raised interest rates by a 0.25% on July 26th to 5.5%. And then this week, Federal Reserve Chairman Jerome Powell announced that they would leave rates unchanged, but they acknowledged significant uncertainty ahead. So, what's most interesting here is that markets have been largely ignoring the Fed recently, and they're really not buying the messages that the Fed is sending. Specifically, inflation is starting to pick back up, and this could mean higher rates for longer. We're also watching how consumers are doing. Consumers are not as financially healthy as they were a year ago. 61% of consumers surveyed in the second quarter of this year said they are living paycheck to paycheck, and the percentage is even higher for younger generations. 74% of millennials and 66% of Generation Z said that they are living paycheck to paycheck. Credit card balances also grew at the fastest rate in 20 years last month, and credit card debt continues to climb, unfortunately. This chart shows outstanding credit card balances from 1999 to today, including a spike in the last year. And then on top of this, the Supreme Court's reversal of student loan forgiveness could lead to some further defaults and increased credit usage. Last, we're watching the labor market and its correlation to personal income and consumer spending. We're a consumer-driven economy, so the amount we spend really makes a difference. As I've mentioned before, unemployment is a lagging indicator, so even when unemployment is low, we need to watch the trends closely. So non-farm payrolls increased more than 187,000 jobs in August. And when overtime hours are reduced across the labor market, followed by a cut in temporary staffing, and then the hours are reduced further, unemployment can tick up. Weekly jobless claims this week came in at the lowest levels we've seen since January 2023, with continuing claims also declining. So this is good news. Again, just something to watch closely, and we will be doing so. My belief is that markets should generally remain strong for the next decade, especially when you factor in favorable demographic trends and what history tells us. But of course, big drawdowns will likely occur over that time frame, and probably more frequently. And of course, nothing is guaranteed. So it's important to be mentally prepared for more rides on the market roller coaster. We will continue to remain proactive in managing risk on behalf of our clients, and we encourage 401k participants to evaluate your own accounts and to do the same. And as always, we're here to help you make investment decisions based on your own personal risk tolerance and unique goals. We talked in a past update about managing bear market fatigue, and I'm going to reshare this one slide because it's so important. Keep in mind that the best and the worst days in the market tend to happen together. Investors can miss significant upside potentially when they make emotional decisions and when they pull out of investments in a sudden dip. So keep in mind that this chart really just kind of means that you need to think about your own investments, assess your own risk tolerance, assess how you're feeling, and try to avoid making emotional decisions. If you're a client of ours, know that we're proactively monitoring your investments and we're working to keep them in line with your own risk tolerance. If you know me at all, you know I value face-to-face interaction, and nothing will ever replace that. I also know that digital communication like YouTube is vital to keeping our clients and communities informed. And if you haven't yet, please go ahead and hit the subscribe button. I provide the same unvarnished, balanced information in these videos as I do in my client meetings, and it's a great way for you to stay on top of your investments. I know I've given you a lot to think about, so we'll end here for today, but thanks so much for being here, and we'll see you in our next video.